Hello guys, so the pastry and cake story ended in the last video itself. Now it's time for a new story to begin. We are going to learn ledger and T accounts. So what is ledger? Journal entries are basically posted into T accounts, so which is known as journal entries posting. So let's take 5 simple transactions to understand the entire ledger and trial balance process. I started business with cash rupees 1 lakh. Cash is coming into the business, it is increasing. So asset increase means debit. Capital, I have told you in the last video as well that when capital increases it will be credited. So cash account debit to capital account. Then we have bought goods worth rupees 10,000 on credit. Purchase account debit to trade payable account. Purchase account, which is an expense or asset, whatever you may consider it. If it is increasing, then it will be debited, and trade payable is a liability. Increase in liability is equal to credit. Then we have sold goods worth rupees 12,000 on credit. Trade receivable account debit to sales account. Trade receivable, it is an asset. Increase in asset is equal to debit, and sales, as it is an income, increase in income is equal to credit. Paid trade payable rupees 10,000. So in this case, trade payable account will be debited to cash account. This trade payable has come from the second transaction. So like there is a liability which got created in the second transaction. Now removing it by paying them rupees 10,000. So trade payable account debit to cash account. Cash is decreasing, asset decrease means credit. Trade payable was a liability, as we are paying that liability, so it will be decreasing. Decrease in liability is equal to debit. And the last transaction, received rupees 12,000 from trade receivable. Cash account debit to trade receivable account. Cash is an asset, increasing, 12,000 rupees debit. Trade receivable was again an asset, but it is decreasing, so credit. Now after writing these journal entries, we will make the T accounts. From these transactions, 5 transactions, you need to identify how many accounts are involved. Cash account 1, capital account 2, purchase account 3, trade payable account 4, trade receivable account 5, and sales account 6. In case of 4th and 5th transactions, these accounts are already considered, so you don't need to worry about it. So the total accounts that we have with us are 6. So you need to first count how many accounts we have, so that you will draw the T accounts accordingly. So we have 6 accounts: cash account, capital account, trade payable account, purchase account, sales account, and trade receivable account. See, in the cash account, if you remember the first transaction, cash account debit to capital account, you just have to copy that journal entry into these accounts. Cash account is above, that means debit to capital account, rupees 1 lakh. Similarly, immediately you have to show the effect in capital account as well. For capital account, cash account was debited, right? But for capital account, it will be credited, because capital account was credited in the first transaction. So buy cash rupees 1 lakh, in this case to capital rupees 1 lakh. Then in the second transaction, we bought goods worth rupees 12,000 on credit. So we will go to the purchase account, we'll show to trade payable account 10,000 rupees. This trade payable account 10,000 rupees, and in trade payable account we will show buy purchases 10,000 rupees. Then we sold goods on credit. So trade receivable account debit to sales account 12,000 rupees, and again in sales account we will show buy trade receivable 12,000 rupees. Then we paid money to trade payable. So in trade payable account we'll go trade payable account debit to cash account. Immediately we'll show the effect in cash account as well. Buy trade payable rupees 10,000 rupees. So in cash account, when the cash balance is increasing, it will come in this side, whereas when payments are made, it will come in this side, just opposite of bank passbook. In case of bank, you see that if someone says rupees 10,000 is credited into my bank, you consider it as your balance is increasing. But in case of accounts, it is the opposite. So in cash account, it will be opposite. Increase will be shown this side, decrease will be shown this side. Then after making payments to trade receivable, we received cash from trade receivable. So in case of this transaction, we will go to the cash account. Cash account is debited and trade receivable account is credited. So in cash account increasing, so to trade receivable 12,000 rupees, and immediately we will show the effect in trade receivable account. Buy cash rupees 12,000 rupees. So in trial balance, what you have to do, you will make this kind of a format: trial balance, head of accounts, debit, credit. Cash account, you will go to the cash account, you will see what is left. So in case of cash account, we have 1 lakh and 12,000. Total comes 1 lakh 12,000. Whereas trade payable was in this side was just 10,000, so we have deficit of rupees 1,02,000 because both the sides will be equal always, just like balance sheet. So we will write the deficit by using this statement called by balance carried down. If it is on this side, you will write by balance carried down. If it is on this side, so you will write to balance carried down. In case of capital account, we have by cash rupees 1 lakh. In this side, we had no transaction. So for that reason, I used to balance carried down rupees 1 lakh. So whatever to balance or by balance carried down is written, you will take this amount into the trial balance. See, trial balance, cash account. You remember the amount left there was 1,02,000 rupees. So I used it here. Cash account is debited. Cash is an asset. Generally, assets are to be debited only. So we will show it on the debit side. Whereas capital is related to trade side. You remember the rules that I've taught you. Under asset, under the debit heading, you will have always asset, expenses, losses, and drawings. Whereas in case of credit, you will have capital, income, gains, and all the profits you make, and all the liabilities as well. So accordingly, we'll use that rule for making the trial balance. So we saw capital account was again to balance carried down 1 lakh rupees, so we took it here. Then we'll go to the purchase account. Purchase account again to trade payable we have 10,000, and in this side we had nothing, so we used by balance carried down rupees 10,000 rupees. So I've shown trade payable. In case of purchases, right? So yeah, purchases rupees 10,000 rupees. Trade payable account. In trade payable account, you have to look it very carefully. We have purchases rupees 10,000. Again, we made cash payment to rupees 10,000. So the account is balanced. We didn't use to balance carried down or by balance carried down. So this account will not be posted in trial balance. Similarly, in case of trade receivable as well, we sold rupees 12,000 rupees of goods to trade receivable. Then we received the payment. So the account is balanced. We didn't use any to or by balance carried down here. So it will be also not posted in trial balance. See, it's empty over here. Trade payable 00, trade receivable 00. Whereas in case of sales, we have by trade receivable rupees 12,000 rupees, and here we had nothing. So by to balance carried down rupees 12,000. This amount will be again shown here. Sales. So now we have to check whether both the sides are equal or not. Debit total is 1,12,000, credit total is 1,12,000. It is matching. So your answer is correct now.